So we start with the first technical session of this conference, which is on a very interesting topic, that is on evaluating global financial architecture and regulatory practices, progress and the way forward. And on the dais we have with us Gemini Bhagwati, who is the RBI Chair Professor at ICRIER. He'll be chairing the session. And among the panelists, we have Suman Beri, non-resident fellow, Bruegel and senior fellow, MasterCard Center for Inclusive Growth. Ashima Goyal, who's the professor at IGIDR. Parag Vaknis, who is the associate professor of economics at Ambedkar University, Delhi. And Alok Sheel, who's the former additional chief secretary, Government of Kerala, and secretary, Prime Minister Economic Advisory Council. So over to Gemini, sir. Thank you.
Good morning, everyone. Very warm welcome to this ICRIER conference. We have 4 distinguished panelists. You have their names both in front of them as well as in the brochure you must have got. We have an interesting topic today to talk about, which is global financial architecture. I'm not sure what the G20 has achieved since the crisis of 2008 in terms of improving that financial architecture when it comes to market risk, credit risk, operational risk, execution risk, and I won't amplify on what those risks are right now. I have exchanged a few emails with the panelists, and I'll just list those issues that I had flagged, which could perhaps inform our session today. And I will go strictly by the order of speakers as listed in the program. But let me just flag those few issues. Number one, which comes to mind, is that the US is threatening countries, pardon me, with sanctions if they buy oil from Iran. Now, it's not as if you can't buy oil from Iran, but you can't do it in US dollars, which is the preeminent international reserve currency. Now, I would assume that in a world in which we want to cooperate with each other, in which the world wants to move forward from the situation in 2008, what could be the response of the G20? I want the audience to reflect. The panelists already have that particular question in their inbox through an email by me. Russia is a member of G20. Russia is already under sanctions from the US, and one thing which bites them, as I remember the Russian ambassador in London telling me, that his staff is finding it difficult to open bank accounts because, I won't get into the details, of sanctions that the US has imposed, and the UK banks were falling in line. The next item, violations of market integrity. What do I mean by that? Somebody sets up a company in a tax haven like Mauritius, or for that matter, Singapore or Cyprus. And India has double taxation avoidance agreements with all 3 countries. The one with Mauritius we have amended. I'm not suggesting all companies do that, but some companies do that as a way to avoid tax. I would think that global financial architecture should address this issue of tax avoidance as distinct from tax arbitrage. Tax arbitrage is fine. I mean, it's legal. But willful tax avoidance is not. And I would hope that some of the Western countries which rail against Ireland's policies of low taxations, I think the maximum corporate tax rate in Ireland is about 12%. And Google, and you name it, Yahoo, everybody has their corporate headquarters in Ireland. They might have an office with just 3 people in it, or 4. The next issue is auditing and accounting. Very boring stuff for most people. I think auditing and accounting, as we know from the ILFS example, somebody calls it the Lehman moment for India. I don't think so. I think it's exaggerated. I think some of the measures which are being taken are not really because the entire financial sector in India is under threat. But be that as it may, auditing and accounting, particularly for cross-border transactions, I think that should be part of how the global financial architecture is thought about and how do we set up norms that countries respect across borders. With that, I hand the floor over to Suman Berry, who's the first speaker.
Okay. Following the guidance of Mrs. Ahluwalia, I'll come here because I believe I'm more visible. I certainly am height challenged, so that's another reason for doing it. Let me say that I'm honored by the invitation from ICRIER to be, as it turns out, the lead technical speaker at this G20 conference. It's of particular interest or importance to me because, as I was introduced, I'm now a non-resident fellow at a think tank in Brussels, but that association, I think I'm right in saying, actually began at the first ICRIER G20 conference, which took place in 2008, where Bruegel was invited. So today I'm wearing multiple hats, but I'm dominantly a non-resident, wearing the hat of a non-resident fellow of Bruegel, and so I'm representing them, but I'm speaking as an Indian, of course. That's relevant because as I get into my remarks, much of what I know on, as it were, the regulatory side comes from colleagues in Bruegel who have maintained a steady stream of commentary on what the G20 has been attempting to do in regulatory reform. So there I will be more a carrier pigeon. I have my own views on other aspects of which I'm going to talk about, and those are based on a rather extensive review of G20 summits over the last 10 years, which is with the editor at Bruegel, with the idea that it would be published at the time of the Buenos Aires summit or shortly before. So it's a mixture. But let me start with what you've already heard in the opening session from Sanjeev Sanyal, from Dr. Ahluwalia, from Amitabh Kant. What should be our expectations, indeed, even from the chair of this session, Dr. Bhagwati, I should say Ambassador Bhagwati, High Commissioner Bhagwati, I don't know which, all. Which is, what is it reasonable to expect of the G20? Sanjeev, in the opening session, talked about this as being one of the institutions for global governance that has been invented since the war. But I have come to the conclusion, on the basis of my thinking and the review for my own study of the G20 summit at 10, which is that it is, at the end of the day, it is a congregation of heads of government. So these are the heads of national governments coming together to, as it were, immerse themselves in the important issues of the day. Let me slightly, as it were, in contrast to both the agenda of the Argentine presidency and also some of the points that the CEO of Niti Aayog, Amitabh Kant, made, I, as an economist, continue to accept what the G20 said at the Washington summit in 2008 and reiterated in the last summit, the Hamburg summit, which is that while they range very widely, as they must as politicians, their core mandate is, as it were, steady, sustainable growth. And the financial agenda is very much part and parcel of what Sanjeev talked about, that his framework working group is responsible for, which is balanced, sustainable growth. Why am I saying all this? I'm saying all this because this is a group of politicians, supported, of course, by their national civil services, who do not shed all the political pressures on them once they enter. Indeed, I would say that the most important dimension of the G20 as compared with, say, the General Assembly of the UN, where many of them meet, or some of the other fora, is that this is where, as it were, the tensions that 10 years after the crisis the world is exhibiting are on display and have to be negotiated in a communique. So I just wanted to make that point. Sanjeev talked about the Sherpa track. What we're talking about here is, as it were, activities under, I mean the finance track. These are activities under the finance track of the G20. My remarks after having talked about the G20 are basically in three buckets. The first is regulatory. The second is something which I believe has been neglected, but is of particular importance to the emerging markets, which is the international monetary order. And then I would like to close with some comments about the way ahead, particularly as seen from the perspective of India. But as I said earlier, the regulatory piece really comes from work of a well-known and sort of well-published colleague of ours at Bruegel, Nicolas Véron, who has been present and been an invitee at the ICRIER conference in the past. And it may intrigue you to know what his most recent contribution in this area, available on the Bruegel website, is entitled. It's called "The Global Financial Regulatory System Needs a Chinese Dream." I will start by talking about the global financial regulatory system as he describes it, its successes and failures. This is a part response to the agenda that our chair put forward. But I do think for India, and I'll come back to this at the end, the Chinese dream component is also relevant. The key points, those of you who are specialists in this area can go to the Bruegel website and find the underlying paper, or I can give you the reference. He makes the point that basically the cross-border regulatory architecture really started in the 1970s. There wasn't much beyond that, but it has proliferated. As many of you know, the expression by the G20 of its interest in this area was the upgrading of the Financial Stability Forum into something called the Financial Stability Board. And since India is a member of the G20, it also is represented at the FSB, as it's called. But it would perhaps be a surprise to you to know that Nicolas lists no less than 18 international bodies. I'm not sure whether all of them attend all FSB meetings, which have jurisdiction on regulatory aspects of cross-border, including the accounting aspects, etc., that our chair talked about. Nicolas makes 3 points that I want to share with you before I move on to the stuff that I'm more familiar with. The first is that each of these have very different jurisdictions, and the second, that typically the banking ones work better because there's a longer history through the Bank of International Settlements for the central bankers to work together. There's much less experience of securities regulators and accounting regulators working together. Another point that he makes, which is important to, I think, India, is that this whole infrastructure or this whole structure is still dominated by representation across the North Atlantic. He himself, coming from a European think tank, makes the point that in many of these organizations, including the FSB, not only is the ECB, the European Central Bank, represented, but also central banks of individual European countries who actually have no reason or right to be there because ever since the ECB took over the supervisory function for the major banks. So the point I wanted to make here is that it is a complex structure. The FSB is a channel by which the G20 influences what goes on here. But let's be clear that all that the G20 can do is to provide broad guidance on very technical matters through their communiques. And after that, it's really a question of how these signals are picked up by the individual institutions. I mentioned the Chinese dream. I'll come to that at the end, but it's been teed up by the point that I've already made about the North Atlantic dominance. Now, it was not in the list of issues that the chair put forward to you, but there is another aspect of the international financial architecture, which is the international monetary order. I don't know how many of you saw a recent reflection in our newspaper Mint by Montek Singh Ahluwalia on 10 years since the Lehman Brothers crisis, where he talks quite favorably about the importance of the FSB. But he makes the point that at the famous London summit, if you like, the iconic London summit, it was Gordon Brown who basically said we need a new Bretton Woods. Now, we've heard relatively little about that since, and in the discussion, I think, because I'm told I'm approaching my time, so let me just make the various points why I think this needs to be on the agenda. There has been discussion of this in a famous speech that Raghuram Rajan gave, but essentially the point that our chair made, which has also been made by some Europeans, and in fact it has been a lament of the Europeans before it became a concern of the current emerging markets, that there are asymmetries of power in having a national currency, the US dollar, be the main reserve currency. We were more concerned in the past about the lack of fiscal discipline on the United States, but what we've seen, to use a phrase that's been used, what we have seen is that that now has led to the so-called weaponization of the dollar. And so, for various reasons, the fact that the reform of the international monetary order, which the Chinese and the Stiglitz Commission, etc., thought was going to be an important aspect of the G20's deliberations, has only found reflection in the issues of governance of the IMF. So let me return to the Chinese dream and looking ahead from the perspective of India. My colleague Nicolas Véran entitled the piece the way he did, and this is in 2017, before perhaps the scale of Chinese ambitions through the Belt and Road Initiative were entirely plain. But he simply made the point that a global regulatory structure dominated by North Atlantic regulators, with the Chinese playing, until this point, a essentially peripheral role, either by choice or because of lack of invitation, is just fundamentally inappropriate given the scale of the Chinese financial system, given the cross-border links. I don't know how many of you saw the piece in The Economist, I think last week or week before, which is that really the RMB dollar rate is now becoming the metronome for exchange rates, including euro dollar, etc. So his plea was basically that China, for scale and potential, needs to become much more central. And this will bring me, for shortage of time, to my final point, which is that given the geopolitical tensions that there are between India and China, should those get in the way of us making common cause on some of the issues that interest or concern the emerging markets in the international financials architecture. My own hope is that they would not. We are proud of announcing that by next year we will displace the UK as what will it be, the 4th largest economy in market at market prices and exchange rates. And yet my own sense, Alok Sheel can correct me because he has actually been at the coalface, is that we are hesitant to, as it were, chance our hand to, as it were, articulate a positive agenda. So I hope that in the discussion amongst the other panelists and with all of you, we can talk about what that positive agenda should look like and whether indeed it is in India's interest to promote China in the international financial architecture. A little disjointed, but I haven't exceeded my time too much. Thank you.
Thank you, Suman. You have been bang on target. Thank you so much for keeping to the time limit. I'll now request Professor Ashima Goel to give us her views.
Thank you, Gemini, and thank you, ICRIER and Rajat, for keeping this conference going for 10 years and inviting me repeatedly. I used to think, what can I say now that I haven't said? But this whole area is so critical for the world, and so much has changed that I'm actually grateful to Rajat for forcing me to go back and see what is happening and what needs to be done. So what I'm going to first briefly touch upon the progress that has been made because compared to I used to study after the East Asian crisis, there were so many ideas in academics about how to change financial regulations. Nothing happened. This time a lot has happened because the major power centers were involved. So we have a main focus on banks, which is actually higher capital buffers, lower leverage, and but this is actually a negative for developing countries, for emerging markets, because their finance tends to be more bank dependence. And while banks were not involved so much in markets and so on, they're forced to become more conservative in many ways. And they're subject to all kinds of other regulation normally. Then making derivative markets safer, also quite a bit has been done. Moving OTC derivatives to electronic platforms. Shadow banking, because the focus on banks led to arbitrage towards other forms of finance. But even here, there have been initiatives to shift shadow banking to market-based finance, in general to improve transparency, auditing, disclosure. This identifying entities should prove to be a big positive for money laundering, etc., to stop that. And to know what is happening, what are the sort of risks and where they are distributed. But country progress is not uniform. In particular, only 68% of countries are compliant with risk-based capital rules that cover the markets more broadly than just banks. And there is further revision of Basel III rules being contemplated to, because this building walls higher and higher, you find that people are finding ways to do what they were doing earlier. So you need to keep fine-tuning regulations. Then there's pushback from markets saying that there is more volatility due to tough global standards. And the standards need to be made more risk-sensitive. Standards need to be similar only if they are systemic. Otherwise, allow more innovation. Someone made this point, and diversity. Shadow banking, there are major problems. In liquidity management, there's not much progress. And there are data gaps. Systemic entities too big to fail has not really been addressed here. So what are the ongoing concerns? Banks have more capital, but there is much more concentration. Diversity is a very important attribute of a stable financial sector, but US banks have become more dominant because they move much faster and other banks have shut down. Then quantitative easing has led to a rise in debt through the globe. I won't go to the details, but large part of this debt has been with the government and then corporates, many of these corporates in emerging markets, not so much in households which have deleveraged. But China has seen a huge increase in debt, and and since this has taken place in a period of extra accommodative monetary policy with very low interest rates, this is very vulnerable to a rise in interest rates as monetary policy becomes more normal. Basel III has encouraged arbitrage away from banks, so you've seen a huge increase in mutual funds, in hedge funds activity, which comes under the rubric of shadow banking. So again, those statistics are there. No time to go into all that. So the problem is that all this kind of lending and increase in debt has raised asset prices which are ruling very high. But we need to make a distinction when we are seeing, is the financial system safer now, between asset prices and excess leverage. If interest rates go up as part of normalization of policy because growth is higher, asset prices may not crash because that is a factor tending to support them. And there is some diversification and discrimination among countries whose fundamentals are somewhat better. Long term, there is a shift perceptible towards emerging markets away from US stock markets, which tend to be overpriced. Then, as we've seen, hedge funds have grown tremendously. But the question is leverage as high there as it was in banks prior to the Lehman crash? So these equity funds have been substituting for banks as they have withdrawn because of higher capital buffers. But what has happened is that the investors in these hedge funds are long-term investors who would lose, pension funds and so on. And this is not systemic unless there is a widespread growth collapse. Moreover, the leverage in the kind of loan funds that these funds float is something like 2:1 compared to 30:1 for banks, which is allowed for banks. So therefore, this leverage is less dangerous. But the problem is that these hedge funds don't have high quality assets, and they don't have access to lenders of last resort if there are systemic issues, if markets begin to seize up. The other positive is that cross-border flows, which were a major cause of the problems in the global financial crisis, have actually decreased by 52%. And there are no very large swaps and explosion in the notional value of derivatives as was there in 2008, where derivatives had grown from 100 crores to 516 crores just prior to the crash. And the unsecured interbank market has also shrunk. The scandal facing Libor, it's been replaced by a Sonia. But the problem is liquidity supply. If growth slows, as interest rates rise, and these deals are no longer profitable, when people start exiting, what is going to happen? Because banks are no longer that dominant. They have retreated from making their traditional two-way quotes in markets. They used to be market makers. So now, what is going to happen? It's true that they are not, but there is higher quality capital. So if people start losing money, they can absorb it without failing or going to the taxpayer. But regulators are concerned about this and have been discussing this. I'm sure in G20 this is discussed behind closed walls. But the main positives or the way they are pushing is to move towards more technology. And actually, MiFID, there was a lot of protest in the market when these rules were applied, but it has led to a rise in trade volumes because electronic and exchange-based trade actually reduces the compliance burden and costs, and you see a rise in volume. So that might provide adequate liquidity. But the problem is that algo trade in these exchanges tends to be pro-cyclical. They withdraw in bad times. So in a nutshell, will there be more reliance on central banks to provide liquidity? Will they have to function as market intermediaries, as it did in crisis times, as many Western banks, central banks have been doing? Will there be a rise in banks' reserve demand? And is there sort of moral hazard if this continues? Can it continue? Banks have been trying to retreat and wind down QE, central banks in the West. And even there was concern politically about the large powers these banks wielded. So there has been legislation to reduce their lender of last resort capability. And therefore the space, because interest rates are so low, there's less space to cut them. And in the Trump era, we are seeing a retreat from global coordination and a systemic attack on international institutions. So the triumph of G20 was really the coordinated stimulus just after the crisis. Will such a coordination be possible today? That is a big worry. And at the same time, political backlash, because the reforms have largely tended to return the system to what it was with some more safety buffers. But politically, there's a lot of concern about inequality. So you're seeing populist leaders who are doing things that are destroying the international order and making finance more unstable. But all this is just a preamble. Actually, I wanted to focus on emerging markets because when Rajat forced me to look at this literature, I found so much discussion because of the anniversary. It was 10 years since Lehman. But all the discussion, the majority of it was from the advanced economies point of view. But emerging markets there's been a lot of drama recently, we've seen risk on, risk off capital flows. Again, the numbers are here, which show huge inflows at times. And Helen Rhee has done some research which shows that this is coordinated with US financial tightening, the risk off periods when capital flows out of emerging markets. And the reasons are then global, not due to emerging market domestic cycles. And in this year, what has happened is the US political actions, which have forced a rise in oil prices, which make India vulnerable, and also the US fiscal stimulus, which has led to a strengthening of the dollar and therefore weakening of emerging market currencies. And but neglecting emerging markets is a big loss for G20 because their share in global GDP is now more than 50% and has been rising throughout this period. So even if a crisis is avoided but growth slows, this is going to affect every country in the world. And here, this is where I think G20 can make a big contribution because a lot of this QE money went into emerging markets, into corporate debt, which is vulnerable to a rise in interest rates and to currency volatility because this dollar risk, which when some of these firms are not hedged. So what is the advice that G20 can give? How to deal with this? And to provide institutions that can support liquidity, such as there's less information or research in such markets, so a global emerging market fund has been suggested in the literature. Then liquidity facilities, since the IMF is unlikely to get much funding from the US, in any case their funds are inadequate. So central bank swaps and regional central bank swaps. But there are moral hazard issues, so therefore the IMF can, the conditionalities which can reduce this moral hazard. And then counter-cyclical investment credit, then some measures that should apply to reduce pro-cyclical activity, such as the US raising deficits at the top of a cycle and increasing pro-cyclicality around the world. We've seen very dramatic experiences in individual emerging markets. Both Argentina, when I say what sort of advice, both Argentina tried very orthodox policies. Their interest rates have risen to 60%. Turkey heterodox, Erdogan enemy of raising rates, but even their interest rates have gone up to 24%, but still they have 40 to 50% depreciation of their currencies. Now China, despite a lot of criticism from the world, has managed to maintain counter-cyclical macroeconomic policies. In 14-15 there was pressure on the renminbi, but they've increased capital controls and they're widely expected to be able to keep their rates lower and they had started to withdraw credit accommodation to contain the shadow banks, but they're likely to be able to maintain some stimulus even as the US rates rise because of this. So we need to study these policies better. And although emerging markets, most of them are in a better position today because fundamentals are stronger, but the share of equity investment has risen. but still select this rise. In India, for example, the corporate debt is very low compared to other emerging markets because of restraints, but we are suffering from an oil price rise, current account deficit because of that partly, and rupee volatility. In 2017, capital controls were relaxed. There was real appreciation that contributed to a fall in export growth. We are not able to finance our imports. Our interest rates were too high relative to the rest of the world, so large debt inflows got about 9% excess returns. And intervention in that year added about 53 billion to reserves. But this was not enough to depreciate the rupee. There was still appreciation. And the US Treasury labels countries as currency manipulators if they intervene more than 2%. We exceeded that, even with our limited intervention. So therefore, these kind of international norms, G20 should take a stand on these kind of issues. What is it that countries need to do? India has a current account deficit, so how can you call it, put pressure on it not to accumulate reserves? And industry has been in a slowdown since 2011, but our policies have been very, very heterodox, very, very orthodox, conservative. What Larry Summers calls Stone Age monetary ideas have reigned in India. And recently we're seeing issues of systemic risk and pressure on the rupee. So this I want to label this because this is the same issue which is facing international markets, that if there is a problem in shadow banks, if liquidity dries up, what will happen? Because in India, we have no facilities no window to provide regular credit to these banks. So then illiquidity can become insolvency. So I'll just close now because I'm out of time. But there are a lot of figures here. And ultimately, I would just say that EM should not have to handle capital flow volatility alone. Nuanced, context-sensitive advice. That there is will hide. The market was very excited about the recent monetary policy, for example, that rates were not raised to defend the rupee. But actually lower rates can, because a lot of these analysts come and talk to me, and they would say things like, if the rupee has risen, they get a capital gain if interest rates fall. So if the rupee is going to recover, it's going to appreciate, it's reach a bottom, they will come in. So even non-conservative policies can actually keep inflows in and improve financing. So therefore, thank you. We need advice on what these policies should be, what works in different countries, what is going to work in Indian conditions.
Thank you, Professor Goel. I'll now request Professor Parag to give us his views.
Thank you, Gemini. Thank you, Rajat, for inviting me here. I was a little bit relaxed there because I was hoping that Mr. Sheel will go before me. But yeah. So I'm going to talk about, in general, global financial architecture. What are the challenges, or what are the challenges that continue to be there, and which kind of define the context in which the developing countries, as a part of G20, have to negotiate their way through. And some of these points could be important as we think about what are the strategies that we need to adopt. So there are 3-4 points that I wanted to concentrate on. One of the terms which has become very popular after, I think, Raghuram Rajan used it before, is basically the bigger than neighbor monetary policies. So I'll talk a little bit of that and how that poses a problem It is basically a fancy way of saying that there are spillovers and they need to be taken into consideration. Then I'll also talk about this phenomena of global safe assets shortage and what that means for cross-border capital flows and thank you. Cross-border capital flows and also exchange rate management and exchange rate movements in general. And then I'll briefly touch a little bit about on US dollar as an international reserve currency. So as we all know, the 2008 financial crisis, which also led to larger deliberations on the part of G20, also saw unfolding the unconventional, or what has been termed as unconventional monetary policies in the literature, which is basically in response to the crisis, the Fed and other developed countries' central banks basically reduced the interest rates. Interest rate being the primary instrument, and what this has led to, and we have already seen that, is basically institutional investors moving all around the globe in search for safety and yield. I'll talk about safety more in a few minutes. And this also led to basically wide movements in exchange rates. We also saw that there was also movement from certain asset classes as investment vehicles to primarily currencies, where immediately after the crisis, I don't exactly remember the year, there were some countries which actually had to suspend trading in their foreign exchange markets to not allow wide movements in foreign exchange rates. Because foreign exchange rates also pose significant challenges for managing domestic monetary policy and its effects. So basically, capital flows caused by such policies pose significant risk to emerging market economies and reduce their monetary policy effectiveness. So so as developing countries, and especially developing countries, because we already are suffering, or we already suffer from weak institutions, and therefore that limit our capacity to manage domestic monetary policy and its objectives. As a part of G20, we should be basically arguing about how to internalize the effects of the spillovers as we continue to develop more on our institutional basis. Closely linked to this particular phenomena of unconventional monetary policies and their spillovers is basically this phenomena of safe asset shortage in the global economy. Now, this basically continues to be a threat, and it will continue to be a threat for at least a medium to long-term planning horizon for any economy, included in the G20 or not, is basically shortage of these assets. So what is a safe asset? A safe asset is a simple debt instrument that is expected to preserve its value during adverse systemic events. And so institutional investors around the globe basically look for parking their funds into these assets. And up until now, most of these safe assets have been produced predominantly by advanced economies and mostly by the US. And therefore, what basically happens is there's a continual demand for dollar-denominated securities, which basically creates pent-up demand for the US dollar. And capital basically flows across borders to basically restore equilibrium in global and local safe asset markets. Now, largely after the 2008, mostly the demand for safe assets has outstripped the supply of safe assets. And therefore, this pent-up demand for safety is always there, is always ever present in the global financial system. The zero lower bound, which is basically interest rates cannot fall below zero, basically says that we have to look for an alternative adjustment mechanism, and therefore that basically is the currency market that we have. And this basically leads to appreciation of United States dollar and depreciation of buyer country currency. So these pressures which are present because of the safe asset shortages on US dollar for continual appreciation and the buyer currencies for depreciation make management of foreign exchange currencies much more difficult. Now, I'm not really sure what the answer is for this, but it needs to be recognized, because once we recognize there is a safe asset shortage, it also means that we recognize the possibility that there would always emerge private substitutes to these safe assets, which may or may not be comparable in terms of their risk profile, which basically increases the probability of asset price bubbles and increased risk premia in the system in general. Of course, the solution is promoting safe asset production, which is not really an easy thing to do. But there is a good argument for a public debt issue, which could be financing infrastructure. But of course, with the recent situation in India, we are a little bit doubtful about that too. So what does this basically say about US as being an international reserve currency? So the third point, or the third continual threat that basically defines the environment within which the G20 countries have to work and negotiate their way through is the US dollar as being an international reserve currency. Now, in general, theory is very clear. I mean, we do have a lot of models which basically show why in a multi-currency world, why a particular currency would emerge as an international reserve currency. But in general, the world would be much better off if we have an independent global reserve currency, which is not so sensitive to the macroeconomic and the geopolitical considerations that we have today. So one thing, I mean, you all are pretty well aware of all the benefits of an independent global reserve currency. But I think there is one thing which the G20 countries should and could argue for and lobby for is going for an independent standard that we have. All right, so what are the things that we can do? Building institutional capacity at the domestic level to handle the effects of exchange rate movements and unconventional monetary spillovers. The Fed's policy has significant effects on cross-border flows, on asset prices across countries. And so, as Bernanke argued in one of his papers, is that, well, you have been talking about all spillovers, but then you all can make some policy decisions which will kind of reverse all that US does. But then we actually know that reversing those kind of effects is not a straightforward exercise, because country central banks also have other objectives to think about, which may conflict with reversing effects of developed country spillover, monetary policy spillovers. So there should be more argument about how developed countries can actually internalize their spillover effects and not just consider their own domestic markets while considering the policy. Because in general, it is not the effects of the spillover effects of US Federal Reserve policy is not only for the other countries, but they also come back and revisit the United States. So that could also be one of the arguments that we make there. And of course, if we could I'm a professor, I teach in a class, and so I can make these kind of statements, which may or may not work in strategy circles, which is basically if we can lobby with other countries for adoption of an independent global reserve currency as a long-term agenda for a G20 meeting, because there will be a lot of short-term and medium-term domestic concerns that would come up as strategic concerns in these negotiations, but also keep this as a long-term goal, which would contribute significantly to the strengthening of global financial architecture. And so history has shown that we are basically going up in the level of aggregation. We started as tribes, villages, region states, and now we are at the level of nation states. And now we are basically talking about a global cooperation where there is this need of subsuming national interests towards a greater common good. In that, we basically arguing for a global reserve currency, independent global reserve currency, would be a good strategic goal and a long-term goal for G20 as a group to argue their way through. Thank you. I think I am a little bit less in time, but I'll stop here. Thanks.
Thank you, Parag. That was very interesting. I now request the former Secretary in the Government of India, Mr. Alok Sheil, to make his remarks.
Thank you, Gemini. It's always a challenge to be the last speaker. I think the tolerance levels generally go down. So I'll try my best, because much of what I had to say, I think, has already been said, but maybe in a different way. There are 4 parts to my presentation. The first, I'll just outline what I think is the global financial architecture. Secondly, whether financial markets, how have they adjusted in the wake of the global financial crisis over the last 10 years? And what has been the progress of the G20 financial regulatory reforms, much of which I think Ashim had already covered, so I'll just go over that very fast. And global finance and the real economy, and what are the near-term risks and long-term prospects. Firstly, the global financial architecture. If you look at global financial assets, they estimated at about 340 trillion in 2016. And if you compare that to the size of the global economy, it's about 5 times. And of this, shadow banking comprises about 50% by a broad measure, and this is the FSB's terminology, and 15% by a narrow measure of shadow banking. Advanced economies are much more leveraged than emerging markets. And also, non-bank credit is much more important than advanced economy financial markets than in EMEs, which are mostly dominated by bank credit. Of course, we exclude the informal sector because you have a big informal sector in emerging markets. But Europe is a little different from the Anglo-Saxon markets, where bank credit plays a much greater role. Then the US financial markets are the biggest and deepest, and they account for about 40% of global financial assets. And of course, when US financial markets sneeze, everybody catches a cold. The US dollar is the global reserve currency, and as a result of that, US monetary policy is a major driver of the direction of cross-border capital flows, which is what we are seeing today in emerging markets. And during the global financial crisis, interestingly, it was the US Federal Reserve that provided the liquidity of the last resort, and it stabilized financial markets. And going on, the Bretton Woods institutions, which used to be at the center of the financial architecture after World War II, have gradually diminished in size and importance, even for major emerging markets like India. And their role is mostly confined to surveillance and policy advice. Then after 10 years, where do we stand? There is an overhang of liquidity, but it is not leading to consumer price inflation, which is exactly what was the trend before the financial crisis. asset prices have rebounded strongly. If you look at the Dow Jones as a proportion of the GDP, it is higher than what it was in 2007. If you look at real housing prices, they are at 2004, 2005 levels in the US. And those were, the real housing prices prior to the crisis were at historic highs. Then following the bailouts and write-downs, American banks have recovered strongly, much more strongly than European banks. Although stock prices and return on equity is still lower than in the heady days of the global financial crisis, the Australian and Canadian systems have hardly been affected. They've been carrying on as business as usual. European banks have shrunk sharply, perhaps because the governments there are weaker, fiscally weaker. They have not enforced bailouts and enforced write-downs like the way they have done in the US. And big banks have become bigger in the consolidation process. And if you see the top 20 financial institutions now account for 42% of assets under management compared to 38% in 2008. Then leverage in advanced economies has continued to grow. In private leverage has remained more or less the same, but it is public debt as a percentage of GDP which has risen sharply. And EMEs have taken advantage of low rates to borrow more. And much of this increase in debt is in non-financial corporates, in EMEs, followed by households. And the public debt has increased, but it's been modest in comparison. Then central bank balance sheets have increased dramatically. And the US Fed balance sheet has only just begun to shrink. And ECB and BOJ are still expanding, 10 years after the crisis. And one could argue that this quantitative easing has underwritten the recovery in Western financial system, and which is still on life support. If that much of that is the size of the central bank balance sheet has not shrunk at all, it is still on life support, and it is booming. And it has also underwritten fiscal expansion by keeping market interest rates down, because if you see the increase in debt, the next slide will show the increase in debt in advanced economies. It's almost doubled as a share of the GDP in a period of 10 years, which is quite dramatic. And here, the other thing is, other graph is on the growth in debt. As you can see, the red line, private leverage has more or less remained the same, and it is the public debt which has increased. And here's a chart on the central bank balance sheets. The US is the one at the bottom, which is just beginning to shrink, but it's more or less the same, whereas the others are still ascending. Shadow banking seems to be rebounding more strongly than the banking system, and cross-border flows have declined, and foreign currency reserves of emerging markets have gone up despite the decline in global imbalances. And especially during the period between 2009 2013, it has increased by $3 trillion. And over the last 3 years, it has actually declined. So here, this is an interesting graph from the Bank of International Settlements, which shows the bank credit cycles and the non-bank credit cycles. The blue is the bank credit cycle, and the red is the non-bank credit cycle. And if you see, since the 70s, they have both moved in reverse directions. The last time when they moved together synchronously was during the financial crisis. And if you look, what is the position today? The bank cycle is, has not recovered, it's not booming. It is the non-bank credit cycle which is, on the upswing, which probably is maybe a good thing that the two are not synchronous, and maybe it is the non-banks which are making up for the deficit in the banking system. Cross-border capital flows have declined. Ashima had covered that. Coming to regulatory reforms, I'll just go through. How much time is left?
You have 7 minutes.
7 minutes, okay. Just to do a big bird's eye view. It's been under the overall guidance of G20 leaders. That is how the process began. The restructured Financial Stability Board was the chief agency used by the G20 for coordinating these reform efforts of national authorities and international setting bodies like BCBS for banks and IOSCO for shadow banking.